Nowadays, there are so many people talking about Australian real estate on social media platforms. Those relatively professional ones are generally operated by real estate agents. The funny thing is that different agents have different investment philosophies. Some advocate buying luxury homes, some suggest purchasing new properties in developing suburbs, and others insist you buy second-hand houses priced between $300,000 and $500,000 across Australia. Most media accounts holding these different views follow the same pattern. They promote one type of property and criticize all the others. If you listen carefully, they all make some sense. Experienced investors definitely won't buy those views because they know what they want. However, people who are just starting property investment find it hard to make a choice. In this episode, we'll explain all those investment philosophies in Australian real estate in one go. What type of investment property is worth buying, and which kind of people are suitable for which type of property. In the end of this video, I'll present the 4-step investment selection method that we've been using with our Vision members. This is a method we've developed over more than 4 years of refinement, trial and error, and improvement, suitable for most people. You can use it as a reference. Today's video is a bit brain intensive. If you come across this video and understand it, it's excellent. Your future path in property investment will certainly be smoother. If you don't understand, that's okay. Watch a few more times. Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. In Australia, real estate agents are roughly divided into 3 types. Number 1, second-hand property sellers agents. These are the agents you meet when attending open inspections for second-hand homes. They're the ones dressed sharply in suits on Saturdays and Sundays, wandering in front of properties. They present the property to potential buyers, and their duty is to find ways to sell the property and collect commission from the sellers. Number 2, new property agents. They first secure stocks from developers and builders and then figure out how to sell it to anyone capable of buying a property, collecting commission from the developers and builders. Number 3, buyers agents. They help buyers find properties and, after successful purchase, collect commissions from the buyers. These 3 types of agents, regardless of their personal thoughts on investment, each project their unique investment philosophies through social media and other channels. Agents of the same type often share similar buying and money-making concepts. I'm not praising or criticizing here, just stating the facts. Number 1, second-hand property sellers agents. Second-hand property agents usually tell buyers that only the current property is good. This house has a large plot of land, unique features, a comfortable living environment, excellent lighting, a good school catchment, and limited supply. Only so many people can live in this area. When one family moves out, another can move in, so it's definitely profitable. After discussing this property, they won't go further. They won't tell you much about what kind of property to buy next because they might not even know what stock they will have next. Number 2, new property agents. New property agents, sometimes also called project marketers or wealth coaches, tell buyers that buying 6 apartments lead to financial freedom. Of course, this was the saying many years ago. Later, because the overall price increase in the apartment market wasn't ideal, this concept changed to needing 8 apartments for financial freedom, and then it became 12. If you're not financially free, just buy a few more to fill the gap. Their stock is, of course, selected from hundreds of projects, and the 3 to 5 projects the company secures are the best ones. Or perhaps they can get exclusive group buys at very low prices and so on. New property agents emphasize that buying one property isn't enough, you have to keep buying with them. What if the property price drops after purchase? No problem, you won't lose money as long as you don't sell. If you meet a new property agent, they'll definitely say that new properties are much better than second-hand properties and that you must not buy second-hand properties. They'll go on about how great new properties are. Later, when traditional off-the-plan apartment agents saw the market situation wasn't favorable, they expand their stock to include townhouses and single-contract house and land packages because the sales methods were the same and training costs were low. 3. Buyers agents. Buyers agents are divided into 2 levels. 1. Transactional buyers agents. These agents help you buy properties one by one without any wealth building philosophy. They take money to do the job, but generally don't put much thought into it. The buyer needs to be knowledgeable and instruct the agent on what kind of property to purchase. The agent then does the legwork. Number 2, strategic buyers agents. These are impressive. They have a complete investment philosophy and know how to maximize their own interests as buyers agents. For example, they might suggest buying second-hand houses for around $500,000 across Australia. Buy 8 or 10 of them and you achieve financial freedom. Some of these agents promote themselves by claiming to have self-developed data analysis software or even market themselves using artificial intelligence. In reality, they're just using publicly available data platforms that anyone can subscribe to for a few $100s a month, far less miraculous than they boast. Buyer's agents will definitely tell you how bad new properties are and that you must not buy them. If you do, you'll lose money. Well, of course, if buyer's agents say new properties are good, how can they sell old ones? Interestingly, both new property agents and buyer's agents claim to be absolutely neutral and stand entirely on the buyer's side. I'd like to say more on this. There's no absolute objective and neutral business, and also property strategy can't achieve absolute neutrality either. Any business is definitely out to make money. That's what all businesses are. Our goal is to help clients make money while making money ourselves. Achieving this win-win situation is the best. The property investment philosophy of new property agents and buyer's agents are basically at two extremes. New property agents disparage old properties and praise new ones. Buyer's agents disparage new properties and praise old ones. But in reality, we've seen people investing in new properties. Some make money, some lose money. And same goes for investing in old properties. Buyers have their own reasons for purchasing new or old properties. They're all solving their own problems. Rational investors choose solutions that are most suitable for themselves. To sum up this matter in one sentence, all roads lead to Rome. The goal is financial freedom. The method to achieve this goal is investing in Australian real estate. As for how to invest, what kind of property to invest in, and when to invest, I believe it should start from the buyer's own situation, tailoring an investment plan. Each investor's suitable investment strategy and property type are different. In property investment, there's a strategy called active investing, which involves rolling up your sleeves and spending some time, like renovating old houses, building a granny flat, tearing down and rebuilding, and subdividing. We won't discuss these active strategies because these aren't the strategies I use. Our main strategy is passive investing. Through property investment, we obtain passive income to achieve financial freedom, freedom to quit jobs, freedom to travel, and throughout the process, reduce your active involvement, reclaim your time, and enjoy life. This is what Aus Property Strategy is doing and is the investment method suitable for the vast majority of people. Within passive investing, there are two very typical investment strategies: high capital growth and high cash flow. These two strategies are at two extremes, and most people's strategies are somewhere in between. Let's start by discussing high capital growth. The overall logic is to buy mainstream properties in mainstream areas. Through the property's appreciation over the next few years, you refinance and extract equity and then purchase the next one. By repeating this process and increasing leverage, that is, the amount of loans, you raise the total value of your investment portfolio, amplify the speed of capital growth, and enhance the return of your principal. The profit comes from property's price increase. In a high interest rate environment like now, rental income can hardly offset the costs of holding the property, making negative cash flow more likely. Essentially, you're using negative cash flow each year to bet on high capital growth. Of course, whether your cash flow is positive or negative and by how much depends on market factors. For example, long-term rental or short-term rental. Short-term rentals generally yield higher income. Land tax in your state or territory, insurance, maintenance, and interest expenses. Another factor is the loan-to-value ratio. With the same interest rate, the more you borrow, the higher your repayments, and the tighter your cash flow becomes. In my words, LVR is like the gear of a car. When property market is good, the prices are rising fast, shift to a higher gear, borrow more and earn more. When the market isn't doing well, shift to a lower gear, reduce leverage and be more stable. By mainstream areas, I don't mean expensive neighborhoods, but properties within the metropolitan area or surrounding development suburbs. Of course, property prices in mainstream areas vary greatly from city to city, some around 800,000, others 3 million. The characteristics of these areas are that there are many houses, even more buyers, high transaction volumes, and patterns that are easier to grasp. We can predict the speed and magnitude of future capital growth more accurately. Of course, if after buying, you find that the appreciation isn't as fast, it means you didn't time your entry well, which is quite common in actual operations. But it's okay as long as you hold on and also buy in different cities' markets during different cycles. Your investment portfolio's annual return rate will become increasingly stable. It's easy to estimate when to refinance and how much equity you can extract. The cash for purchasing the next property comes partly from refinancing and partly from the money you've saved over time. The further along you go in buying properties, the more of the deposit comes from equity extraction and the less from your own savings. until eventually you can buy the next property entirely with the money extracted from refinancing without putting in any of your own money. If you have a comprehensive plan like our Vision members, you should start planning your loans from the purchase of the first property to avoid situations where you want to buy more properties but the bank won't lend you money. Everyone in Australia has a borrowing limit. The question is whether you have the ability to find ways to increase that limit. Ausproperty Strategies' loan team is the strongest in Australia. The word strongest is well-deserved. You can check the loan volumes of our loan strategist. He is number one in Australia. The 5 methods we've developed together to increase borrowing limits haven't even been fully utilized, and you've already bought several properties and achieved financial freedom. So in reality, as long as our Vision members follow the loan strategies, it's hard to encounter loan bottlenecks. When your personal investment portfolio reaches a certain scale, say after 5 to 10 years, you need to start thinking about how to convert it into your ultimate goal, having the option to retire at any time while having sufficient passive cash flow. When purchasing your next property, you need to switch strategies to focus on cash flow with capital growth as a supplement. After all, when we are not working, we need continuous passive income. Then, when you actually retire, you can sell a few investment properties to pay off the loans. Perfect. The opposite of the high capital growth strategy is the high cash flow strategy. Many buyer's agents use this strategy to educate buyers. They suggest purchasing properties around $500,000, preferably houses in suburbs you've never heard of. After all, where can you find houses below $500,000 in suburbs you're familiar with? The overall strategy is that you can get started with about $100,000 for your first property. The cash flow is decent, and holding the property isn't stressful. So you keep it and wait for the price to appreciate. Even if it doesn't appreciate, that's okay. I've heard of some clients of buyer's agents who buy 10 or so houses worth $400,000 to $500,000 each across Australia. The money for buying the houses and the loans didn't come from property investment profits. They just had that much money to begin with. Wouldn't it be better to buy a luxury home to live in? Maybe they already have one. Low-end properties around $500,000 have a certain chance of remaining flat for many years, then experiencing a rapid surge, and then entering a long-term flatness again before rising. So if you want the property to appreciate quickly after purchase, you need to time your entry very precisely. For example, some low-end suburbs in Perth and Adelaide in 2022. Price increased by about 40% within 2 years, but from $350,000 to $500,000 is an increase of only $150,000. Refinancing would get you just over $100,000, barely enough to buy another $500,000 property. At this point, the problem is whether you can still find properties worth $500,000 across Australia that can appreciate quickly in value in the next 2 years after buying your first one. Basically, with the low-end second-hand property strategy, if you want to follow the path of capital growth and refinancing to reinvest, you need to get every step right in the early stages and time every point correctly. Only then can you fundamentally increase the asset scale of your investment portfolio and reinvest the money earned from property investment back into it without having to save to invest. Low-end second-hand properties don't align well with high capital growth strategies, but fit well with high cash flow strategies. Think about it. When you start investing, you don't have much money. Your budget isn't enough to buy mainstream properties, and you don't earn much from your job, so you can't withstand the pressure of negative cash flow. Then you can only buy low-end, high cash flow properties and hold them long-term. We've come across many people in Australia who use these strategies. Single moms who need a lot of security are particularly fond of this investment strategy. People nearing retirement also like this strategy because, after all, the cash flow is high. The high cash flow strategy has 2 problems. One, inability to quickly expand your investment portfolio. Not that it will definitely happen, but the possibility is high. Because the property price is relatively low, even if there's a surge, the amount of refinance is low, and the value of the next property you buy won't be high. If the property you bought doesn't perform well and remains flat for a while, the timing to purchase the next property will be delayed because you can't refinance to extract equity. In other words, the strategy of relying on property appreciation to buy the next property isn't that effective. Of course, if you originally had $10 million in savings, that's another story. But if you have that kind of money, why buy low-end properties? You need to think about that yourself. 2. Reaching the loan limit faster. The cash flow strategy is generally suitable for people with average earning ability. Relying on average earnings, you'll quickly reach the loan limit, even if the property appreciates, and in theory, you can refinance to buy the next property. Whether you can get the loan is still a problem. Among our Vision members who use the cash flow strategy, they all need to start building a loan structure and enhance their borrowing capacity when buying the first property. This is somewhat challenging for ordinary people to do on their own. The high capital growth strategy relies on price appreciation and achieves financial freedom relatively faster. The high cash flow strategy gradually increases wealth and it feels comfortable to use, but pushes the goal of financial freedom further. Both methods have their merits, and they're suitable for different groups, but all roads lead to Rome. After choosing the investment strategy that suits you, it's time to select properties. If you think buying a house is simple, you're oversimplifying it. When our property strategy helps Vision members select properties, we go through 4 steps. Selecting a property is not an easy task. All houses are good houses, they just suit different people at different times. When choosing a property, our property strategy follows 4 steps, moving from a broad scope to a narrow one, which you can refer to. Number 1, Australia's economy and international affairs. This includes factors like changes in Australian political parties, what immigration, education, and real estate bills are being discussed in Parliament, the US economic trends, international conflicts, and so on, all aspects covered in this first step. Many property investors lack this perspective, especially those who focus only on their work or family and rarely watch the news or pay attention to political, economic, and international situations. These big trends are intricately linked to Australian real estate. But it's okay, as long as you follow our property strategy and watch every episode, we've already taken care of this first step for you. Number 2, state and territory policies and market cycles. The scope narrows in the second step, shifting focus from international and national issues to individual states and territories, for example, Sydney in New South Wales and Melbourne in Victoria. You need to understand the overall market trends of real estate in various cities, policy changes, taxes, financial subsidies, immigration, and education. Besides reading news reports and conducting research, you also need to look at the overall real estate market data of each city. Similarly, fans of our property strategy can handle this step by closely following our videos and monthly live webinars. Number 3, selecting areas nationwide. The third step focuses even more narrowly, down to the suburb level. Australia has over 15,000 suburbs. How can you find the ones that best fits your property investment strategy? For choosing suburbs for second-hand properties, our property strategy's solution is to first purchase nationwide real estate market data that fits the budget of our Vision members from several data platforms. This filters down from over 15,000 suburbs. Then, data analysts employed by our company analyze and sort this information to pick out 10 suburbs that align with the Vision members' investment strategy. Oh, by the way, recently the position of our company's data analyst has been replaced by AI. Using AI costs me only a few $100s a month with higher work efficiency and more accurate results. Why spend money hiring people? The final step is for the investment strategist handling the case to conduct manual research and select the 3 most suitable suburbs for the members' reference. Our goal is to find areas with an annualized capital growth of 5% to 8% over the past 10 years, a gross rental yield above 5%, a vacancy rate below 1.5%, and where demand exceeds supply. If the suburb is undervalued and happens to be at the beginning of an upward trend, that's even better. So the 3 steps are 1. Purchase data, 2. AI filtering, 3. Manual screening. When choosing new properties in development suburbs, we first need to understand all development zones in Australia's major cities. People who follow our property strategy have watched our on-site research videos. It's no exaggeration to say that I've led teams to conduct on-site research in development suburbs around all major cities in Australia. Development suburbs generally have less historical data. Mature second-hand property areas can provide complete historical data records, but development areas must be visited in person to understand their current situation and future development. We obtain government planning documents for the development areas, including plans from departments like water, electricity, gas, internet, education, transportation, and infrastructure. Sometimes we even need to verify information with local city councils to conduct a complete evaluation of development suburbs' potential. Why don't we rely entirely on data but ultimately require manual screening? Actually, when our property strategy started, we did rely entirely on data, but later we found that data research results deviated from reality. For example, data couldn't predict government fiscal policies, infrastructure development directions, black swan events, or changes in immigration and international student policies. The population decrease in cities during the pandemic, with people flocking to the countryside, was also unpredictable. Therefore, manual final screening is necessary. These are the methods used by our property strategy. We believe that using this method is enough to be responsible for the investment returns of Vision members. If you want to conduct the research on your own, you should align your methods with ours. Of course, everyone's situation is different. How closely can you align depends on your own energy and analytical ability. Number 4, selecting properties. After finding the target suburb, it's time for the property selection stage. If you're buying a second-hand property, you can search for listings through public channels or find off-market properties. Sometimes which channel you can use to get property depends on luck. After identifying a target property, you need to analyze its investment potential, input basic data, and calculate purchase costs, holding costs, and cash flow. If there's no problem at this stage, you can proceed to the purchasing stage, including negotiating the price, terms, purchasing contract, and subsequent long-term or short-term rental and sale. If you're buying a new property, there's an extra step before selecting a property, choosing the project and developer. It's best if the land developers and builders are medium to large-sized, experienced, and have been in the business for over 7 years, having survived at least one property market rise and fall without collapsing. Ordinary people can do this background check by spending some time. O's property strategy goes a step further. We need to know the big bosses or executives of the developers and builders and be familiar with the character and style. This is because a company's behavior is generally a reflection of the owner's personality. If the owner is a good person, the company won't bully buyers or default on payments. Without this step, people are easily misled by market promotions. Every developer and builder seems good, but there's not much you can do about it. Vision members don't have this risk. After passing the developer and builder stage, it's about looking at floor plans, construction prices, settlement dates, and other details. There's not much difference between individual new properties. O's property strategy has developed the Golden 21 Rules for property selection, which will be introduced to everyone for the first time in my new book to be released in February next year. Stay tuned. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.